Hello again, everyone. This is the Chapter 8 practice problem video. Chapter 8 was all about budgeting, and that's going to continue through Chapters 9 and then really through Chapter 10 in a way for our performance evaluation and our variance analysis. But anyway, we're going to start here with Exercise 8-2 from your textbook, a production budget. And that problem said Down Under Products of Australia has budgeted sales of its popular boomerang for the next 4 months as follows. So we've got that for April through July. The company is now in the process of preparing a production budget for the second quarter. Past experience has shown that end of month inventory levels must equal 10% of the following month's unit sales. Inventory at the end of March, so right before this April here, was 5,000 units. So before we prepare a production budget by month here, I did want to just talk for a quick second about that. As you read a little bit about in Chapter 8, a lot of assumptions we make about these inventory levels, there's several different reasons for those, right? So if you think about a company selling, this boomerang here or selling anything really, probably want to have some inventory on hand in case our demand is greater than expected. You never want to turn a customer away, in other words, right? You always want to make sure we can fill customer orders or requests. Now, there is such a thing, too, as being overstocked, so we want to be cognizant of that. But in this case, the company's decided that a good enough cushion is about 10% of the following month's expected unit sales, just to account for any kind of bumps in demand. Okay, so I'm going to add a little bit of formality to this and say this is Down Under Products Ltd. This is our production budget, and this is for period end, looks like 7/31, whatever year. Okay. Now in Chapter 8, you read about how the sales budget kind of kicked off this whole master budget process. We had to forecast demand for our products to know what resources we needed to be able to satisfy that demand, right? How many units of product we needed to make, and then how many inputs we needed to make those things in terms of labor, materials, and so on. So let's just get going here with our production budget. We're going to do this for, for second quarter. So we're actually starting with April and going May and June. So this is actually for period end June 30. Okay. We've got that July information because we need it to forecast the ending inventory for June. So first up in our production budget is going to be budgeted or expected sales. Remember, that's the key driver of production, how many units we expect to sell. So in April, that's 50,000. May, it's 75,000. And then June, it's 90,000. So we have to cover that. We also know that we want to be able to cover our desired ending inventory. So here in April, we know that's going to be 10% of May's expected sales. So remember, our rule was 10% of the following month's unit sales on hand at the end of any particular month. So for April, that means 10% of May's expected sales of 75,000. For May, that's going to be 10% of June's expected sales of 90,000. Again, I'll try to avoid the cell references here, but I want to make sure the connection's clear. And then for June, that's 10% of our expected July sales, shown in the box at 80,000. And there we go. Now, budgeted sales plus desired ending inventory, we can call this, total needs. Right? Here's all the units we have to cover. So that's sales plus that desired ending inventory. So here for April, 50,000 plus the 7,500. Here in May, the 75,000 plus 9,000. And then in June, 90,000 in sales plus the desired ending of 8,000. But we're not starting at zero. So from that, we want to deduct that beginning inventory. Now here they told us the inventory at the end of March, so just before April there, was 5,000. I do want to point out real quick though that 5,000 does represent 10% of April's budgeted sales. So it seems that this 10% rule the company likes to follow was probably in place in prior periods as well. And if you're not given that information, by the way, you can assume that that rule carries forward in perpetuity. Okay, beginning inventory in May is equal to the ending inventory in April. Right? April 30th to May 1st, it's the very next day. So I'm just going to pull forward that 7,500. And then same thing in June. Beginning inventory in June would be the ending inventory in May. So 9,000. So our total needs minus our beginning inventory would be our required production for that particular period. So April 57.5 minus the 5,000 means we're going to be making 52,500 units in April. Here in May, 84,000 minus the 7,500. And then here in June, 98,000 minus 9,000. And there's a required production of 89,000. But we also wanted to come up with a quarterly total. So let's do that as well. So our budgeted sales would just be the sum of sales across the 3 months. So I'm going to be explicit with the numbers again, 50,000, 75,000, and 90,000. Be careful here with ending inventory. The ending inventory for the quarter as a whole is not the sum across the months. It's the same point in time as the end of June here. So this would be 8,000. Total needs then, budgeted sales plus that desired ending. There's 223,000. Beginning inventory, same thing. We don't want to sum it across. The beginning of the quarter, running April through June, is the beginning of April. So we're just pulling that one forward. Let me just highlight those both for a second. April 1st is the same point in time here. So 5,000. And then there we go. Total needs minus beginning inventory. And there's our required production for the quarter as a whole, 218,000. Next up, we are going to look at exercise 8-3, right below 2 there. And that's direct materials budget. So we know in this setup that 3 grams of musk oil are required for each bottle of this Mink Caress, a popular perfume made by some company out there in Siberia. The cost of this oil is $1.50 per gram. Budgeted production of Mink Caress is given below by quarters for year 2 here, and then the first quarter of year 3. The inventory of musk oil at the end of a quarter must be equal to 20% of the following quarter's production needs. So again, just like with units of finished goods, we want to have some sort of cushion in our inventory of raw materials so that we don't end up, short on material. Now this assumes, of course, that we can get enough out in the marketplace to have this cushion, which if you watch the news lately, supply chain issues has made that very tough for companies. We also know that 36,000 grams of musk oil would be on hand to start the first quarter of year 2 here. So now we want to put together a direct materials budget for musk oil by quarter and in total just for year 2 here. So let's add a little header just to keep ourselves honest. We don't know the company name, so we'll just put company name. This is our direct materials budget, and this is for period end 12/31, year 2. So we're going to do it by quarter and in total. So I'm going to do Q1, Q2, Q3, Q4, and then we'll have our total out here. Now our materials budget, and our labor budget for that matter, are all driven by that production budget. Right? Once we know how many units of finished goods we need to make, then we can figure out what it's going to take in inputs to get us there, in terms of materials, labor, overhead, and so on. So this can start then with our required production, and that's in bottles. I'm just going to note that in parentheses here. Q1 60,000, Q2's 90,000, Q3's 150. So we've got some seasonality, and then Q4 100,000. I'll just go ahead and sum these up real quick for us. I'm going to use a little formula reference there just to make sure my Excel is still working properly. Sum of the 4 quarters, and there's our 400,000. I'm just going to fix my little error here as I go. Now, the next thing we might as well do is get ourselves thinking about raw materials as the unit of measure. So we're going to take that required production in terms of bottles of perfume and multiply it by the 3 grams per bottle of musk oil that we need to make this stuff. So that was our very first line in the setup. 3 grams of musk oil for each bottle. Now this isn't going to change throughout the year, but I'm going to be just explicit there and punch it in across. So that would give us our total needs in terms of material, in this case the grams of musk oil, just to support production. So this is raw materials for production only. And this is the production in units, 60,000 for Q1, times the 3 grams per unit or per bottle. Same idea going down the line here. 90,000 times 3 in Q2, 150,000 times 3 in Q3, 100,000 times 3 Q4, and then of course for the year as a whole, 400,000 times 3 for 1.2 million. Okay, so that's grams of this musk oil just to support production. Now to that we can add our desired ending inventory. Again, keeping in mind that we're talking about the raw material, the direct material itself, not the units of finished product. So not bottles, but grams of this musk oil. Now they told us that the rule was at the end of a quarter, we should have 20% of the following quarter's production needs. So here in Q1, we're going to want 20% of Q2's production. And just be careful, we really want to concern ourselves with production in terms of the material itself, not the finished good. Right? So we want 20% of the 270,000 grams of oil we need to support production in Q2. Q2, we want to have 20% of Q3's needs, so the 450,000 grams. Q3, we want to have 20% of Q4's of 300,000. And then Q4, we want to have 20% of Q1 of the following year. So I'll do this in, a step and a half here. In first quarter of year 3, we need 70,000 bottles produced. So not forget to multiply that by the 3 grams per bottle needed of that raw material. Okay, so that's why this one's a little bit different. Or in fact, just to avoid any confusion too, let's do it this way. Let's push out Q1 of next year. Required production 70,000 bottles times 3 grams per bottle for a total of 210,000 grams. So for Q4 in that year of interest here, we want to have 20% of Q1 of next year's needs of the 210,000 grams. 42,000 grams. Okay. Now desired ending inventory for the quarter or the year, as a whole, the same point in time as the end of Q4, talking about December 31st in both cases. So I'm going to carry that 42,000 there. Now materials needed for production plus desired ending inventory gives us our total needs. So I'm just going to sum those two numbers. I'll use cell references for that. Okay, this plus this. And then I'm going to drag that across. Oops. So in Q2, that's the 270 plus 90, or 360. Q3, 450 plus 60, it's 510. And so on for Q4 and the year as a whole. Okay. Now, similar to our production budget in 8.2, we can deduct from that the beginning inventory. Here in Q1, They told us that was 36,000 grams. But if we look back as well, that is the 20% of Q1's required materials for production of 180,000. So again, this rule that the company's got going looks like it's been in place for a while. Beginning inventory in Q2 is the same point in time as the end inventory of Q1. So I'll pull that 54,000 forward. Beginning of Q3 is the ending of Q2. So there's my same 90,000. And then beginning of Q4 is the same as ending of Q3, or 60,000. Now for the full year, the beginning of the year is the beginning of Q1. So I'm pulling forward that 36,000 from the beginning of Q1 right there. So total needs minus beginning inventory leaves me with my required purchases in this case. We don't make this material ourselves. So in Q1, that's 234,000 minus the 36,000 beginning inventory, or 198,000 grams. Q2, that's 360,000 grams minus the 54,000, or 306. And then I'm going to drag that one across there, since it's just the sort of mechanical math for us. Now, one thing we often do on the materials budget as sort of an ending point or a bottom line is to then project what this is going to cost us. So times cost per gram, and I'm going to fill this out for the quarter by quarter basis as well. So they told us in the setup the cost of this oil is $1.50 per gram. And they didn't give us any indication that's going to change throughout the year. Now, certainly if we expected the price to go up or down or whatever, we could bake that right into our budget here. Okay, if we thought it would jump to $2 in Q2, I could just change that to $2 here and factor it out beyond that. So required purchases times the cost per gram. It's going to be total cost of direct material purchases by quarter. So in Q1, 198,000 grams times $1.50 for 297,000 bucks. Q2, 306 times $1.50, 459,000. And then I'm going to use the cell references for these last ones here. Okay. So what this tells me is for the year on whole, we're going to have to purchase, based on our expected sales and our expected production, a little over 1.2 million grams of this musk oil, which should cost a little over $1.8 million. Again, based on our expectations about the cost of this stuff and what it's going to take us to produce all these bottles of this perfume. Trucking right along, I did want to look at 8-4, a labor budget right below 8.3 there, since it's a fairly abbreviated one, but still gets the point across. 8.4 said the production manager of Rorden submitted the following quarterly production forecast for the upcoming fiscal year. Again, this is our production budget essentially shown right here. We also know that each unit requires 0.35 direct labor hours, and laborers are paid on average $15 per hour. So we want to come up with a direct labor budget for this upcoming year, quarter by quarter. So we are Rorden Co. This is our direct labor budget, and this is for period end 12/31, whatever year. Okay. So we've got Q1, Q2, Q3, Q4, and then this full year summation. We're starting with our required production, or units to be produced. We know that to be from our production budget, 8,000, 6,500, 7,000, 7,500, for a total throughout the year, the sum of those four, or 29,000 units. Now the first step is to multiply that by the direct labor hours required per unit. And that's unchanging throughout the year in this case. 0.35, which makes sense. It's not that often that we'd have a change in labor hours per product. Maybe if we automated part of the process, this might decrease in some cases. But again, we'd be given that in a particular setup here. So that would tell me my total direct labor hours required for production, if I do that math out. So in Q1, that's 8,000 units times 0.35 hours, or 2,800 hours. In Q2, 6,500 units times 0.35, 2,275 hours. Here's my Q3, my Q4, and then again the year as a whole. 29,000 total units times 0.35 hours, or a little over 10,000 labor hours. Now I can go ahead and multiply that by the wage rate, or cost per direct labor hour. And again, I could very much expect to see in practice or in real life a budget that reflected changing wage rates. So for giving people raises, if the cost of benefits is increasing, payroll taxes, whatever, I could build that right into the budget. In this case, we're going to assume that that's $15 across the board. No raises at all. So the bottom line then here, total direct labor cost becomes the product of the total hours required, so 2,800 in Q1 here, times that $15 wage rate for a total of 42,000 bucks. Q2, I'll do the math out, 2,275 hours times 15 bucks. Q3, same idea. Q4, also the same idea. And then the year as a whole, really no different as well. 10,150 total hours times 15 bucks for a grand total direct labor cost of 152,250. I know that sometimes these budget exercises can start to feel fairly repetitive or mechanical, but I encourage you to work through at least a couple just to make sure you're kind of in the groove and you know, understanding exactly the flow and why we're doing what we're doing. One other thing I'd say about labor budgets here, keep in mind that there are certainly instances where laborers have contracted labor hours that aren't necessarily reflective of production. So if, for example, we had a contract in place with our workforce where we paid them a guaranteed, let's just say for argument's sake, you know, 2,500 hours, regardless of whether production supported it, we could also build that into our budget. So in this example, Q1, we wouldn't have to change anything, but Q2, we'd have to bump this up to 2,500 hours times $15 and get a new labor cost of 37,500 rather than the 34,125. Okay, so we could certainly have contractual obligations of that nature. We could also have overtime obligations. So maybe anything above, you know, 2,600 hours, we have to pay time and a half. We could budget for that as well. So in that particular instance, in Q1 and Q4, we would budget for the 200 and the 25 overtime hours at time and a half of our wage rate of 15 bucks. So all those things could be incorporated into our labor budget if we had those scenarios. All right, I wanted to look at exercise 8.5 next, and then we'll bounce ahead a tiny bit. So this is an overhead budget. 8.5 said the direct labor budget of UVL has the following details concerning budgeted direct labor hours. Now the company uses direct labor hours as its overhead allocation base. The variable portion of predetermined overhead rate is $325 per labor hour, and total fixed overheads $48,000 per quarter. The only non-cash item included in that fixed overheads depreciation, which is $16,000 per quarter. We're going to put together then an overhead budget, and then we'll worry about that second part. So this is UVL Corp. This is our manufacturing overhead budget, and this is for period end 12/31 whatever year. So again, we're looking quarter by quarter, and then we'll also look at the full year or the total. First up then is our driver, essentially, our budgeted direct labor hours. So we're told what that was from our labor budget, 8,000, 8,200, 8,500, and 7,800. So for the full year, the sum of those four, 32,500. Now the first thing we might as well do is multiply that by our variable overhead rate. Now that was $325 per direct labor hour, and we weren't given any information to indicate that was changing throughout the year. Again, if we expected some kind of cost increases, we certainly could bake that right into our budget. So budgeted labor hours times the variable overhead rate would give me my total variable overhead. So Q1 8,000 times the 325. Q2 8,200 times the 325. And then same idea for Q3, Q4, and then the full year. All right, now to that, I want to add my fixed overhead costs. Remember, fixed by definition implies not changing with activity, but it doesn't mean we can't have a change in total fixed cost. Like if we expected, insurance rates or property taxes to increase or anything like that. Again, we could build that right into our budget. In this case, we're going to assume everything's staying the same at 48,000 per quarter throughout the entire year. The full year then is the 48,000 times 4, or 192,000. So the first subtotal we want to get is our total manufacturing overhead costs, variable plus fixed. So in Q1, 26,000 plus the 48,000. In Q2, the 26,650 plus 48,000. Q3, add up the variable and fixed. Same for Q4 and that year as a whole. Okay. So that's one very important total from the overhead budget. We do have a second one though, because what we want to do after that is take out non-cash charges so that we can figure out what the cash expenditures for overhead are. That way it can tie out to our cash budget, right? So we know that to be 16,000 in depreciation every quarter, right? That's the very last line here. The only non-cash item there was the 16,000 in depreciation. So as a whole for the year then, 16,000 times 4, or added up, is 64,000. And now our total overhead minus the non-cash charges gives us our total cash disbursements for overhead. So Q1, 74,000 in total overhead minus the 16,000 in non-cash means I'm, writing checks or making charges of 58,000 in cash for overhead costs. Q2, 74,650 minus the 16,000. Q3, same idea. And then Q4 and the year as a whole, no different there. Just a subtraction of the non-cash charges from that total overhead cost. Okay, so really point being on the overhead budget, we sort of want two totals. We want the total overhead costs. That can help us determine our product cost in total. And we also want the total cash disbursements for overhead so we can tie that out to our cash budget. Make sure we're going to have enough cash on hand to pay all these bills. Okay, now the second part said, compute the company's predetermined overhead rate, including variable and fixed overhead for the upcoming year, round off to the nearest whole cent. So thinking way back to chapters 2, 3, and 4, our predetermined overhead rate was always our total estimated overhead for the period, divided by the total estimated activity or allocation base, which in this case is the direct labor hours. So for this particular scenario, that's going to be our total estimated overhead cost for the full year. Now be careful here, it's not just the cash portion, it's the total overhead. So 297,000 625, let my cursor kind of hover there, divided by the total budgeted labor hours for the year of 32,500. So my predetermined overhead rate that I would then use to apply overhead throughout the year, $9, we're supposed to round a cent here, $9.16 per direct labor hour. I had one more exercise I wanted to make sure that I covered, and this is 8-7, just skipping ahead a tiny bit here, for a cash budget. Now 8.7 said Garden Depot is a retailer preparing its budget for the upcoming fiscal year. Management's prepared the following summary of its budgeted cash flows. So again, we know this quarter by quarter, cash receipts and cash disbursements. The company's beginning cash balance for the upcoming fiscal year will be $20,000. The company requires a minimum cash balance of $10,000 and may borrow any amount needed from a local bank at a quarterly interest rate of 3%. The company may borrow any amount at the beginning of any quarter and may repay its loans or any part of its loans at the end of any quarter. Interest payments are due on any principal at the time it's repaid. So for simplicity, we want to assume that interest is not compounded. So let's come up with a cash budget here for Garden Depot. And this is for year end or period end, 12/31, whatever. So let's lay this out by quarter one more time. Okay, so right off the bat, we're going to start with our beginning cash balance. And we know that for Q1, that was $20,000. We don't know what it would be projected for Q2 through Q4 yet. Got to figure that out. To our beginning balance, we want to add cash receipts. For Q1, that's $180,000. Beginning balance plus our cash receipts tells us really what our total cash available at any point would be. So I'm going to get a little subtotal here. We don't always see this, but I like to add it. That's $200,000 in Q1. From that, though, we're going to have to deduct our cash disbursements. Now here in Q1, we projected those were going to be $260,000. So then we want a little subtotal that says, well, do we have an excess or deficiency of cash available versus cash disbursements? And to be clear, we're saying this is the $200,000 cash available projected minus the $260,000 in projected disbursements. Okay, so we're going to have a deficiency of $60,000. So we're going to have to borrow some money. I'm also going to leave some space for repayments of principal and interest to get us to our ending balance budget or expected. So our rule was we wanted to have a minimum cash balance of $10,000 at the beginning of any quarter. Since our Q1 projection is to be short 60 grand, that means we're going to have to borrow $70,000 to get to that ending balance of $10,000 minimum, right? We have to borrow 60 to get me to zero, plus another 10 to have that cushion. So I'm going to borrow $70,000. I don't have any repayment of principal or interest here, so my projected ending balance is that required minimum of $10,000. Now that becomes the beginning balance here in Q2. To that, we're going to add the cash receipts of $330. That gives me total cash available, just to be explicit, of $340. We're projecting disbursements in Q2 of $230. So my projected excess is the difference there, $340 minus $230, or $110,000. Now I can go ahead and repay this loan I had taken in Q1. So I'm going to pay back the $70,000, and I'm going to pay back the interest we borrowed $70,000, and this is 3% simple interest. So I'll just go ahead and mark 3% simple interest like that, okay, for 1 quarter. 2,100. So now my ending balance would be the deficiency, or excuse me, the excess of 110,000 here that we determined halfway up, minus the 70,000 in repayments, minus the 2,100 in interest payment for that repayment of principal. It's a better way to say it. So our projected ending balance for Q2, 37,900. Now that carries forward to Q3, and we'll keep trucking right along. Cash receipts are projected there at 210,000. So we'll add those two together to get the total cash available projected for Q3. We've got projected disbursements of 220,000. So let's take the difference there. And we have projected excess of cash of 27,900. Still well in the clear of our required minimum of 10,000, so we don't need to borrow anything. And that just becomes our projected ending balance for Q3. All right, Q4 then, beginning balance carries forward. We've got projected receipts of 230. Let's add those up to get our total cash available. Minus our cash disbursements of 240. And we've got this excess projected at 17,900. Don't need to borrow anything, don't need to repay anything. So there's our ending balance for Q4. And for the cash budget, we actually don't really need to do that full year view. Q4 is going to tell us everything we need to know to tie out to our other budgets. By that I mean the ending balance on the cash budget also would match what we'd see on the budgeted balance sheet for the cash account. Those things would tie out. We'd see ties to our cash disbursements to all the other budgets where we spend cash. So spending on labor, materials, and so on. If we ticked and tied those. And then we'd certainly see things related to interest expense on our budgeted income statement. So keep in mind, as part of this master budget process, all these pieces that are fitting together. Okay, that wraps up the Chapter 8 practice problems for now. As always, if you have questions, please do let me know. Thanks.